Hello, hello, hello. I'm Owen, and you are watching the Hone Zone. And today we're going to answer the age-old question, the age-old question of, can you really avoid paying taxes? Very, very interesting question. A lot of people are very interested in this topic, but I am going to be discussing whether or not you can actually avoid paying taxes. So let's begin, right? So there are a lot of reasons why you want to avoid paying taxes, but I'm going to put a little caveat before we actually get started. I'm going to little caveat. One, I am not a CPA. Two, I am not an attorney. Three, I am not your advisor. Four, do not listen to me. Five, this is just for your entertainment purposes. None of this information do I want you to listen to from me as advice for what you should do. I want you to listen to this information as what's possible and for you to verify. I don't want anybody listening to what I have to say in terms of this advice because it is not advice. This is entertainment TV. But with that, let's get started. All right. So the question, right? Can you legally avoid paying taxes? So I'm going to say yes. But again, I am not your CPA. I am not your attorney. I am not your advisor. I am not your consultant. I am nothing more than an entertaining person who likes numbers. So let's talk about the first one. It's called a 1031 exchange, right? 1031 exchange. So let's say you own that property at the bottom, that house, and you bought it for $100,000, right? So you bought it for $100,000. Some time passes, and now the property is worth $250,000. And you decide, you know what? I want to sell it. And that house there, that was a rental property. If that wasn't a rental property, you don't need to do a 1031 exchange because there are laws within the tax code that allow you to not have to pay taxes on the sale of your primary residence. So your primary residence, if you're single, you get to have $250,000 in profit completely tax-free. And if you are married, that's $500,000. Again, always check with your tax advisor because I am not it for you, okay? So this property, it's a rental property. You've owned it for a little while and you sell the property for $250,000. Okay, cool. So what that would mean usually is that you would have to pay taxes on the $150,000 profit that you would make. But you watched the Hone Zone and you heard about this thing called a 1031 exchange. And you said, wow, that sounds very interesting. So let me, instead of just pocketing the 150, right? Let's say you got a mortgage for $100,000 and the mortgage stayed flat. It was an interest-only loan for whatever reason, and the principal was $100,000 that you have to repay when you sold the property for $250,000. So there would be $150,000 that would go into your pocket. Of course, we're not including closing costs and all that kind of stuff. I know this, but just to make things simple, because a lot of people like to harp on me like, oh, you forgot all the closing costs and everything else. I know it exists. All right. So calm down. So $150,000 would go into your pocket if you sold it for $250,000. Instead of putting that $150,000 into your pocket, you would hire what's called a third-party intermediary where they would take the funds, the 1031 exchange funds, and they would hold on to it. And then when you go to buy the next property, you would apply those funds to that property. So the next property cost $500,000 to buy. Okay. So if it costs $500,000 to buy, let's say you went traditional, very, very basic loan, 30% down, you put $150,000 down. Okay. So you put $150,000 down and then you bought it for $500,000. And then some time passed, and now that $500,000 building is worth $1.5 million. Crazy. It happens. Okay. So then the same thing, you take that $1.5 million and you then sell that building. You would have profited it $1 million, right? The difference between 1.5 million and 500,000, you profited $1 million. You take that $1 million, you use that as a down payment for another 1031 exchange. $1 million down payment on that bigger building for $3 million. Okay. So you got a building now for $3 million. And that building, right? That building, I'm going to show you guys with a little animation. So that building right here is kicking off $1,200 a month. And the building is 60 units. So 60 units times $1,200 a month, that equals $72,000 a month in gross income, right? Because you own this building, right? Simply because you own this building. And let's say you have expenses, and let's say that those expenses were 50%. So that takes our $72,000 gross down to $36,000 a month. So this property is kicking off $36,000 a month, right? And it all started with a $100,000 building that you bought using a loan that appreciated to $250,000. You sold that, you got more debt, right? You took the $150,000 profit, you used that as the down payment for the $500,000 building. You got more debt, right? So now you have $350,000 in debt because you put $150,000 down. You bought that $500,000 building. Actually, let me do this. Let me use my little let me use that little circle there to help you guys out. So the $500,000 building you bought, and it appreciated to 1.5 million. You made $1 million in profit. You use that money, you put it down on a $3 million building. It appreciated to $10 million, but we're not talking about that part yet. We're just talking about how that $3 million building has 60 units that make $1,200 a month, which is $72,000 in gross income. And then that gross income after expenses might be $36,000 a month. So $36,000 a month, all from a $100,000 investment early on in that single family house. See what you can do, the amazing things you get to do if you know how to do it. And notice all along the way, you didn't have to pay taxes. All along the way, you did not have to pay taxes. And I'm going to show you how that $36,000 a month that you made, you can avoid paying taxes on that as well. Crazy stuff, I know, right? So this is the beginning. This is the start. $36,000 a month, cash in your pocket on a $3 million building that might appreciate to $10 million. So if it were to appreciate to $10 million, what then? What's after that? Okay, let's talk about step up basis. Another way to not pay taxes. Oh, I'm sorry. There's a little thing in the way. So let me get rid of that. Nobody needs to see that. Perfect. Okay. So step up basis. That's where $3 million and then it appreciates to $10 million and then you die. And then your kids inherit the property. And they're inheriting a $10 million asset. $10 million. It goes to your heirs, right? So then they have a $10 million property and they don't want it. They don't want it at all. And so what do? They sell it. They sell it for the $10 million it's worth. So with step-up basis, let's talk about this. Without step-up basis, there's this thing where if you don't have step-up basis and the child sold the building for $10 million, they would have to pay taxes on the $7 million that it seems like they made, because the cost basis was $3 million. You bought it for $3 million, let alone all of the taxes that you rolled forward in the 1031 exchange. So the heir would have to pay $7 million or taxes on the $7 million. Step up basis makes it so that the cost basis is $10 million. The step up basis makes it so that the cost basis is $10 million. And then when they sell it for $10 million, it looks like they profited zero. And so if they profit zero, how much do you pay in taxes? Zero. You pay zero taxes on zero profit. And the profit are in quotations because obviously there's some profit there, right? That kid is walking away with $7 million, even though the building was purchased for $3 million. They're walking away with that $7 million clean because of step up basis. That's a good one. So for those who don't know what that is, welcome to life, you know? All right, let's talk about the next one. Let's talk about a cash out refinance. So remember that little middle property that we bought for $500,000? Let's pretend like you did rehab for $200,000 and there was miscellaneous closing costs and all that kind of stuff for $50,000. So your total all in was $750,000. But then the building appreciated because of your forced appreciation. You're forcing the value to go up. So the new value is now $1.5 million. Okay. So you got $1.5 million over there. And let's see, let me use this, right? You got the $1.5 million value. And then you go to the bank, say, hey, I got this property. It is worth $1.5 million. Can you give me a loan on that property? And the bank says, you know what? Love to. Would love to give you a loan on that. We will give you 75% loan to value. Well, what's the value? 1.5 mil. What's 75% of that? 1.125 mil. What do you owe? 750. So what are we cashing out? $375,000, right? You cash out $375,000. And because that $375,000 is part of a loan, it's the excess of the loan proceeds. You pay zero in taxes, right? You pay zero in taxes. You just got $375,000 in your pocket, 100% tax free because it's part of a loan. Crazy. If some of this stuff is like, whoa, tell me more, feel free to leave it in the comments, right? So $375,000 cash out, tax free, baby. Are we still live? Here we go. Here we go. I don't know what just happened there. That was nuts. Okay, so let's try this again. Let's try this again. I'm sorry. Thank you guys for sticking with me. All right, so we're back. We're back. Here, let's go into this view. $375,000 in your pocket, completely tax free, completely cash out. So that to me is an amazing thing. I thought I lost the broadcast. That was gonna be terrible, terrible day. Okay, so let's talk about the next one. What's the next one? I have no idea. Oh, self-directed IRA. So this is a good one. This is a good one. So in your self-directed IRA, you might have some money. You might either have some money in a traditional IRA or you might have it in a Roth IRA. And when it's a self-directed IRA, that means you get to use the money to buy a building. So you guys see it there, right? I'll use the little shape thing again. Oops. Oh no, where's my little shape? Here we go. So here's my little shape, right? So we're going to use the money that's in the IRA. Okay, we're going to use the money that's in the IRA. We're going to buy a building that we're going to use to rent out. That building is going to give people a place to stay. They in turn are going to pay for that place, right? And then that money is going to go back into the IRA. And guess what? Of course, you don't have to pay taxes on it. Now, if it's a traditional IRA, you're going to defer the taxes. Okay, you're going to defer the taxes, meaning you will pay the taxes at some point. So the taxes might get paid when you retire at 65 years old, 59 and a half, whatever you want, right? But you're going to have to pay the taxes down the line. If your IRA account is a Roth IRA, that money that goes back into the account, that profit is completely tax-free. You never actually have to pay the taxes on that money. So that there is a very interesting way to buy real estate and have it completely tax-free. So if you want to think about it another way, about your 401k, when your 401k goes up, did you pay any taxes on that money? Not yet. Not yet. It just grows completely tax-free. All the profits go back in completely tax-free. Here, this self-directed IRA, it's no different, right? It is no different. You use the money to buy an asset, just like in your IRA or your 401k, you're buying mutual funds. And when those mutual funds go up in value, it goes all that money, all that growth goes back into your mutual fund, completely tax deferred. Same thing here. If this was a traditional IRA and you buy that property, all of the rent that you collect from that property, completely tax deferred. Or like I was saying, if it's a Roth IRA, it is completely tax free. All right, let's go to the next one. I have no idea what the next one is. Let's see. What is the next one? Aha. This is a good one. Cost segregation, right? Cost segregation, bonus depreciation. So cost segregation is where you take this one's a little deeper. Right? So cost segregation is where the money that you put into the building, you get to depreciate over time. And so remember this little guy, we put $750,000 into him. Without taking account for the land value, let's say there was zero land value, we take the $750,000, you divide it by 27 and a half years, and that equals roughly $27,000 a year you get to write off. Okay, $27,000 a year you get to potentially write off. And so now, if you wanted more of a write-off, more than the $27,000 a year, what we can do is we can separate the things that you are depreciating. So we're going to break it up to 5-year, 15-year, and 27.5-year. Your 5-year things are things like your floors, your appliances, things like that. Look it up. Your 15 are your landscaping, your external things, your exterior things, right? So let's pretend like you had $200,000 worth of 5-year depreciable items. So $200,000, and you divide that by 5 years, and that means you get to write off $40,000 per year on 5-year items. On your 15-year items, let's say you had $50,000 worth of 15-year items, you divide the 50,000 by 15 years and you get $3.3 thousand per year that you get to write off. And then what remains is $500,000 divided by the 27.5 years, and that's an $18,000 write off, which is equal to $61,300 per year. Okay, that's a $61,300 write off per year. But if you think about it, you didn't actually spend the money. You own the property, you put all these items in there, and the government says these items are going to depreciate over this time frame, and if it depreciates over this time frame, then you gotta be compensated for it. So this write-off is kind of like a phantom write-off. You're not spending any money towards the write-off, but it does go against your income. So let's pretend like you had $35,000 a year in income, right? But you had 61,300 a year in losses. So you have 61,300 in losses, you have 35,000 in income. That means you still have negative $26,000 in income, which is a carry forward loss, meaning that 26,300 you get to write off the next year. So that 26,300 plus next year you get another 61,300 to write off. Right? So together, what is that? 87,600. So the next year I have an 87,600 $87,600 a year write off. And that is before bonus depreciation. So let's say I was making too much money, right? If I was making too much money and I needed more of a write off than that, well, I get to write off the 200,000 plus the 50,000. I get to do what they call bonus depreciation, and I can accelerate all of that in 1 year. So I can take $250,000 plus the 18,000. The 18,000 is the 5,000 divided by 27.5. I get to take $268,000 a year, and I get to write that off in 1 year in case I make too much money this year. All in all, you're going to max out at writing off $750,000. The question is, do you want to write that off over the course of 27.5 years, or do you want to write that off much sooner? So if the answer is much sooner, then you want to do cost segregation and you want to apply that bonus depreciation. So you get to apply these losses to your income. And again, ask your tax professional. There's different things that you have to file. There's things like being registered as a professional real estate investor, So there are little caveats that you need to know of. Don't just say, "Oh, I heard from home that you can do this." Well, know the rules. That's why I said in the beginning of the video that I am not your accountant. I am not an accountant even. I'm not an accountant. I'm not a PA. I am not an attorney. I am not your consultant. I am not your advisor. I am not your board of directors. I am not a director. I am none of those things. I am just this person who has this very entertaining channel that gives you guys information that you can learn from. So if we were to go through and review all that we talked about, we got the 1031 exchange. That's where we sell a building, buy another building, sell the building, buy another building, and just keep rolling. And then don't forget, you're collecting rent all along the way. So we're collecting that income, that $36,000 a month in. We're collecting that. So that's good. Let's keep on going. Let's talk about step up basis. Let's say you pass away and your building gets passed down to your heirs. Well, your heirs get the step up basis where your cost basis equals to what the value of the building is as of right now. And so if they sell it for what it's worth right now, they make zero in profit because 10 million minus 10 million equals zero. And the taxes you pay on zero profit is zero. So that's great. Next one, cash out refinance. You buy the building and it's worth so much more now because you forced the appreciation, you raised the NOI, you made the building nicer. However you end up doing it, whatever way they appraise the building to show that it's worth more, you then go get a loan, and then that loan pays off your existing loan, and whatever's left over, those loan proceeds, right? Those loan proceeds, $375,000, right? So that's that. All right, let's see what else is on here. Oops, I think I jumped too far. Self-directed IRA. You use the money, you buy a building. That building gives people a place to stay. They pay you rent for that place to stay, and that profit goes into the IRA. It goes back to the IRA. If it's a traditional IRA, it's tax deferred, and if it's a Roth IRA, it is completely tax free. You do not have to pay any more money or any taxes on any of that profit. All of these strategies are available to you. You just may not have heard about it. And then finally, we got the cost aggregation bonus depreciation, right? So this is where you depreciate the building and the items within it. Now, in order to be a real estate professional, you need to spend more than 750 hours a year on that profession, right? And that allows you things like unlimited carry forward losses. So these are little nuances of the strategies, but these are very powerful strategies, right? So those are 5 ways. Those are 5 ways to not pay any taxes. But as a bonus, I will go over a 6th one, right? I will go over a 6th way to not pay taxes, and that is where you buy properties all over the country. Well, let's talk about it this way. You're going to buy properties in areas you like to vacation. So let's say you like to vacation in Hawaii, for example. You would then buy a rental property in Hawaii, and every time you go to Hawaii, you're doing a business trip, right? You have to go. You have to check in on things. You got to make sure that the property is doing well, that the tenant's being treated well, that the landscaping's done just right. Of course, right? You have to go. It's your duty to go and check on your properties. But now because you're going to go check on your property, well, I guess maybe you might want to go to dinner there. Maybe you want to swim with the dolphins there. You might want to go drink a coconut or something, right? So while you're on this business trip, that flight, your stay, all of that stuff is a write-off, which goes against your taxable income. So now you get to use that travel as a way to write off your income. So it's a 2-for-1 special, right? So that's your little bonus one. Use it sparingly. Use it the right way. Use it appropriately. But with all of the things that I just showed you, there's many appropriate ways to reduce your taxes to the point where it's zero, right? It's zero. So you can legally avoid paying taxes, right? Either reduce, defer, or legally avoid. Awesome stuff, right? So if you like this video, if you found this helpful, please share with others, because this information is generally not taught in school. But again, I am not a CPA. I am not an attorney. I am not your advisor. I am not your consultant. I am not your director. I am none of those things. I, again, am just having a entertaining conversation about money. And I'm just sharing my opinions on what I think the situation is. And if any of these things that you just learned about today seem interesting enough to go research, then by all means, go research and tell us what you came up with. And let me know if any of these things apply to you. So with that, guys, thank you so much for watching, and I will see you in the next video.